Hi, good morning, everyone on the West Coast. And here in Utah, where it's 11 a.m., California, 10 a.m., and on the East Coast, good afternoon. Thanks for coming to our webinar today on talking interconnection. For those of you that are on the call, I'm sure that interconnection is a big part of your work. It either impacts your day-to-day work or will impact the quality of your investment. So hoping that a lot of the information that we give you today will be helpful. I'm going to introduce our speakers. First of all, let me introduce our first presenter, who will be Joachim Seel, who's from Berkeley National Lab, and then Avery Wendell, who's from Tower Infrastructure Partners. I'm Ruben Arredondo. I'm an attorney, project development attorney, and just excited to have you both on. Let me do a quick bio, and then I'll have these two gentlemen introduce themselves. So myself, I'm Ruben Arredondo. I'm an accomplished energy professional with extensive experience in Western North America. I've worked for a decade with WEC, the federal government's regulator of nearly 1,000 generation, storage, and transmission owners and developers. I've worked with RTOs and ISOs, FERC, Canadian regulators like the British Columbia Utilities Commission, and Mexican regulators like the Comisión Reguladora de Energía and SENACE. And as a project development lawyer, I usually specialize in helping US and Mexican companies navigate complex energy and regulatory challenges, creating innovative development strategies and assembling multidisciplinary teams of subject matter experts to de-risk projects and drive their completion in the West dynamic energy sector. Dr. Joachim Seel is a policy researcher at the Electricity Markets and Policy Department at the Lawrence Berkeley National Laboratory. His research focuses on solar, storage, and wind market developments, the integration of high shares of intermittent and distributed renewable generation into the electricity grid, and associated effects on electricity markets. His past work experience includes stations at renewable energy offices in Germany, China, and the US. He has consulted private and public clients on energy economics and policy. And Dr. Seel holds a PhD and MS of Energy and Resources and a Master in Public Policy from UC Berkeley. Avery Wendell is one of the co-founders of Tower Infrastructure Partners. Previously, he worked as a consultant for climate tech firms and held roles as a product manager and market analyst at Nextera Energy. Avery holds a Master of Public Policy from Harvard University and an MBA from the University of Pennsylvania's Wharton School. Avery Wendell will present Tower Infrastructure Partners' financial solution to the growing cost of network upgrades. New FERC regulations, rising network upgrade cost, and long interconnection queues open an opportunity for a novel way to finance this growing cost center for developers. TIP brings to bear 20 years of experience in the energy space to solve this burgeoning problem with a unique financing solution. So I'd just like to turn the time over to Joe, if you wouldn't mind introducing yourself, just saying hi to our audience.
Yeah, hello, everybody. It's a pleasure to be here and have the privilege to talk to you. I look forward to a lively discussion later today.
Great. And Avery.
Hi, everyone. Great to be here as well. Thank you so much for joining. I'm really excited to present what we got here and build on some important research.
Great. So I'll just do a quick intro of the topic, and then I'm going to turn it right over to Dr. Seel for his presentation. And after that, we'll just go straight to Avery, and then we'll end with a few minutes of Q&A. Essentially, in the United States, we have a unique model, essentially driven by private property rights. So in most areas, utilities, anybody that owns or operates machines that generate and transport electrons have certain rights to those, and they have the right to be compensated for the use of those. That model has worked for probably 100 years, and it's essentially been the same model where we have generation in one part of a geographic location. It's distributed in bulk to another part, to a substation, and that substation then divides it down to a distribution system, two places where you and I use them in our house or school or office. Now, with the influx of renewable generation, we're looking to put more generation onto substations and lines that were probably never built initially to hold the kind of energy that is that we're wanting to put on it. And so a challenge is essentially, how do I get, as a developer, for example, how do I get my electrons, the one I want to sell, onto the substation of the utility or the local independent system operator, and then onto the transmission line to get it to the point where I need to sell it, and then get it back onto the substation to deliver it to my off-taker, to the person that is eventually going to consume those electrons. And it seems like a simple process, but it's actually become very complex. In the world that Avery and I work in, it's been a real challenge and even killed some very otherwise viable projects. And we're just going to talk about that today. Some of the fascinating research that that Berkeley has done, Berkeley Labs has done, and then also a possible solution. So without further ado, I'll turn the time over to Joe.
Yeah, thank you very much, Ruben, for that great introduction. I've shared my screen. I'm not sure that you can see it already, or whether you need to put it live. Great, there we are. Okay, so it's a privilege to talk to you today. I just quickly wanted to do a disclaimer. I'm a researcher at a federal national lab. The positions that I present today are not necessarily the views of the federal government, and as a national lab, we can also not endorse any individual private entity or company, but we welcome very open exchange and new innovation by the private sector to tackle the difficult problems and challenges of interconnection reforms and transmission investments. And so from that perspective, applaud TPI. I'm quickly going to provide you a little bit of a background on the overall status of interconnection requests, and then dive into associated interconnection costs, what developers and project owners need to pay in order to bring their projects online and ensure that their electricity is able to be delivered to their final customer. So most of you probably know this, so I'll be rather quick in the beginning, but the interconnection process was designed about 20 years ago and has been relatively similar over that time period, although there have been a number of reforms. Usually it starts out with an interconnection request, and then there are multiple study periods. Usually it started out with a feasibility study, system impact study, facility study, and at the end there's an interconnection agreement. Once that is secured, the project starts trying to get an off-taker. Maybe they've done that already before, and building actually the project. And so this is a multi-step process. It is being reformed by multiple ISOs at the moment in response to some new FERC regulations. Cluster studies are going to become more common throughout the ISO and potentially non-ISO areas as well. What is important to note is that there are multiple opportunities to withdraw your interconnection request along this this queue or the study process, which can trigger changes in the configuration of projects that actually seek interconnection and potentially invalidate previous study results, which then requires new studies to be made. And so it's a very complex problem to solve and a problem that has bogged transmission operators and ISOs for quite a while now. Overall, we've seen an enormous explosion of interest in bringing new generators online. Over here on the left axis, you see the annual capacity in blue, and you see it has been nearly an exponential rise over the past few years. Even though in the last 2 years or so, the number of interconnection requests has stabilized, the associated capacity with these interconnection requests has continued to grow. Since the passing of the IRA, we've nearly seen another doubling of new capacity that developers are seeking to bring online. And this enormous rise in interconnection requests has occurred even though there are two ISOs, such as MISO and PJM, that have actually paused the submission of new interconnection requests over the time period over which we collected this data. So once they open their doors again, I think we can expect another rise. What is important to notice here is that the majority of the capacity in these regional interconnection queues is clean, meaning low carbon, mostly solar, followed by storage and hybridized solar storage. Wind and onshore, offshore kind of takes a third place, and fossil generators, natural gas, kind of a very distant fourth position. I quickly want to speak about some problems that we see in these interconnection queues. First of all, there's very low completion or very high withdrawal rate. The majority of projects that have entered these interconnection queues will likely not come online, triggering these restudies. Over here, we have a graph, a map that shows you the completion rates from requests that were submitted up until 2018, and then we kind of gave it a 5-year time period until the end of 2023 to see whether or not these requests have come online or not. And you see there's some regional differentiation, like ERCOT and ISO New England are doing a little bit better, but most of the ISOs really have very, very low completion rates. In particular, this is true for solar and battery. Natural gas has a slightly higher completion rate. What is also interesting is that the withdrawal seems to have taken place not at the beginning of the interconnection process, but increasingly at later stages of the interconnection study process. So you can see that over here, I'm not sure whether you can see my mouse, but the dark parts of the left bars, darkly shaded parts of the left graph, those have increased in recent years. So these are projects that have had even already in a draft or executed interconnection agreement, or finished a facility study and have withdrawn. So that's the case for about a third of the projects there. And that is obviously not ideal. If somebody decides to withdraw because they figure out that network upgrades are going to be too expensive for them, we rather want them to do that at the very beginning and not at the end of the interconnection process. Another problem that we have seen in the interconnection queue is that it just takes an increasing amount of time to actually move the project through the interconnection queues. So over here, at first, we're going to show the time that it is required to move from the initial interconnection request to the interconnection agreement. So move through these multiple study phases that I talked about earlier. And in 2023, it moved down a little bit. That is because ERCOT was overrepresented in that particular annual sample, and ERCOT is a very fast ISO, but for most of the other ISOs, we've seen this increasing duration trend, so that it takes 2.5 years or more on average to go through this study process. And it's important to talk about like these averages. They are representative of a broader distribution. There are some projects that may be able to go through some kind of fast track process, but there are also many projects that are really at the tail ends, where it takes a really, really long time and they're bogged down in these processes. So that is something that is very important to keep in mind when talking today about some of our empirical data. The underlying distribution of projects is really, really wide, and that results in a lot of uncertainty for developers. And that development uncertainty, of course, is really difficult and leads to risk premiums. Now, here we look at the time period required after the interconnection agreement is signed until the project achieves commercial operation, and you can see that those timelines have also increased in some regions like CAISO, a staggering 75 months or so. Across most of the ISO, on average, another 2.5 years. So in combination then, from the initial interconnection request until the final commercial operation date, we're talking about roughly 5 years or so now on average. And that's a lot of time. There need to be down payments to secure a spot in the queues, which binds capital, and just a lot of uncertainty whether or not a particular project can actually move forward and what configuration it can move forward, or whether a developer needs to go back to the drawing board. Finally, I want to talk about increasing costs to interconnect to the transmission system, to the bulk power system for these large generators, and that is the area that Avery will tackle in his presentation afterwards. And first of all, I just kind of wanted to say this: it has been really, really difficult to collect interconnection cost data. It has been a critical knowledge gap for a long time. We've known that these interconnection requests have ballooned, but we've not really understood very well in the academic literature why the withdrawal rates were so high. In part because it is extremely difficult to get good estimates of these interconnection costs, both for developers upfront when they think about where they may want to propose a project, but also even after all the studies have been done, it is very difficult for third parties to methodically collect this data and analyze it in a systematic manner. A lot of the data is hidden, in some PDFs, and it requires a lot of manual extraction. I think there are many actors out there who try to bring innovation to this field and automation, but the current status quo is still extremely complicated to even just get a good understanding of what it costs and how costs may differ depending on what kind of projects you propose at what location. But after we've collected nearly 6,000 cost estimates across 5 ISOs, we didn't look at ERCOT and we didn't look at CAISO for project level cost estimates, because in CAISO we couldn't get that, and ERCOT finances transmission upgrades a little differently. But for the other 5 ISOs, we've collected cost data, and what we found is that both for projects that completed all the interconnection studies and those that are still active, or that have withdrawn at some point from the interconnection process, that costs have risen, often by a factor of 2 or so since the mid 2010s. We've seen especially high increases in interconnection costs in New York ISO and ISO New England. Just again, quick shout out that the underlying data here is really skewed. So a quarter or so have had really low costs, under $25 a kilowatt. But then there was another side of the distribution that had really, really high costs, above $250 per kilowatt, and going up to $500, $750 kilowatt, and even more. What is also interesting to note here is that not only have costs gone up over time, those projects that do face high interconnection costs in many instances then do not go forward but withdraw, just because it is not economic. And so we see here that these withdrawing projects have the highest interconnection costs. What is driving these high interconnection costs? It is primarily differences in network upgrades. And so if we think about interconnection as kind of a 2-part process, on the one hand, you have a substation, a point of interconnection that you need to build in order to physically connect your project with step-up transformers, etc., to the transmission grid. That is one part, what we call point of interconnection cost or attachment facilities. And then there's a separate part, which is actually trying to then bring this newly generated electricity to load centers or off-takers. And for that, you may need to upgrade the overall transmission network. And that is what we bundle here in the network upgrade costs. And you can see that it's really the differences in these network upgrade costs that explain most of the differences in total interconnection cost, both between fuel types, but also between the projects that manage to go and complete the projects, or those that withdraw. And they have the widest distribution in total costs. And again, it is primarily network upgrade costs that have risen over time, which has driven the total increase in total interconnection costs. Quickly showing here as well that there are differences in the interconnection cost by fuel type. So solar projects and onshore wind projects have the highest interconnection cost. Storage, very surprisingly to us, also has fairly high interconnection costs where we've been able to assess it. Natural gas generators in general seem to have lower interconnection costs, and that holds true both for projects that have managed to come online or projects that have withdrawn. So the y-axis over here is a little different for the withdrawn projects. But even among like the new solar projects, so we're talking now about $100 per kilowatt for the most recent round of studies. Why is that? Well, it's difficult to really study it, in part because it is difficult to get good geographic data of where these projects are really located and what the strength of the system, the network system is, where they try to interconnect. There are sophisticated models that the ISOs run, and there are some third-party consultants that offer such services for developers as well. We've been able to get project-specific latitude, longitude information for only 2 ISOs so far, in SPP and PJM. And there you can, it seems that with the increasing distance to the nearest high voltage transmission line, interconnection costs seem to rise. But it's probably a multi-factor, multivariable equation that governs these interconnection costs. And it's very difficult a priori to understand exactly what interconnection costs at particular locations may be relative to others. I want to quickly touch on some reforms and solutions. So the Berkeley National Lab has participated in this Interconnection Innovation Exchange. That is a new project set up by the US Department of Energy that involved a lot of stakeholder engagement and involvement, at the end of which there was a roadmap to accelerate the interconnection process. It's published now. It came out earlier this year. It's a nice document to read if you're interested. So there are some links here to that. Basically, it has tried to identify 35 solutions to mitigate queue backlogs and go beyond the recent FERC orders to increase data access and transparency, to improve interconnection processes and timelines, to increasingly promote economic efficiency, but also maintain a reliable, resilient, and secure grid. In the interest of time, I'm not really going to go into all of these in details, but if you are interested, I encourage you to have a look at that. There are a couple of webinars that try to dive deeper into individual subchapters. For example, at the end of this month, we're going to have a webinar looking at enhancing the interconnection process, and at the beginning of December, a webinar on interconnection reliability assessment models and tools. Past webinars are available as well on this website, where you can look at the slide decks or look at the webinars recordings themselves. Finally, if anybody is at ESIC this next week, there's going to be a workshop on this topic as well. And with that, I thank you very much. If you have any questions that we're not able to discuss today, please feel free to follow up with me afterwards. And with that, I'm going to pass it on to Avery. Thank you very much.
I hope you guys can see my stream now. Great. So first of all, thank you, Joe and Ruben, for setting this up. Sorry if there are any technical issues, but just to sort of bring this back, what Joe sort of outlined there is a growing and burgeoning problem in how we approach financing these projects. Effectively, if you think about it from the broad perspective that he's showing it from, there's a problem on the whole grid that impacts every partner who touches it. But there's a more specific problem. This is impacting the individual financing of specific projects. And if you want to find the micro problem that's going to slow down a lot of this rollout, that's where the problem exists. And so my colleagues and I at Tower Infrastructure Partners, who are working on building a financial solution to this effectively financial problem, these burgeoning costs are creating a new set of problems for renewable developers, and it calls for a myriad of solutions that can be enacted over time, over months, years, and then eventually decades. But we think we have a financing solution to sort of move this forward. So to just sort of restate the problem that Joe was generally talking about, and to make it specific, and before I do that, I want to say that we at Tower Infrastructure Partners have relied heavily on LBL's data. They are just an incredible resource. If you can look into their yearly reports on the interconnection queue, obviously we've relied on their network upgrade evidence. It's just an incredible resource. So I can't emphasize enough that you should check out their research. And moreover, like, they were incredibly personally helpful when we were asking general questions about the space. So it's just a really wonderful public resource. But just to now make the broad problem specific, what's happening is that network upgrade costs that used to be hundreds of thousands of dollars or millions of dollars are now tens of millions of dollars. Basically, what's happened is that the spots on the grid that have capacity and therefore have cheap interconnection costs are now gone. And as that's been the case, the cost for interconnection has spiked everywhere. The sort of specific problem this presents is twofold. The first is for less well-capitalized developers, this means they have to abandon projects earlier than they would want to, or they just simply don't pencil at all. They just don't have the capital to move a project forward, and they abandon it or sell it for cheaply. So this doesn't really work for the development model we've set up on a basic level. But the second problem is that even well-financed developers who have either institutional backing from investors that back the space in a huge way and have access to cheaper debt sources, this just drags down the cost. In the best case scenario for how network upgrades are treated by utilities, you are still putting forward now up to 10 to 20% of the project 3 years before COD. And you, again, in the best case scenario, will see reimbursements on that, something we'll touch on in a second. But you basically have significant and overwhelming costs that hit you early in the project and thus drag down the time-weighted returns. This is all made even more complicated by the fact that none of this is ITC eligible. So you cannot fold these costs into the traditional the traditional financing stack that is used for traditional projects, because a lot of this needs to be financed without the tax equity that is traditionally relied upon. So what you're looking at then is a huge and growing cost that can be 20% of the project that you can't use your traditional financing stack for. And the result is evident in LBL's data, which again, I can't emphasize you guys should go look at. But what we're seeing is that, looking at their data, what it's showing is that projects are getting withdrawn, as Joe said, later in the process. And those withdrawn projects all have extremely high interconnection costs. And so as the cost of the average network upgrade goes from 10 million and goes closer to 20 million, we have at about 15 to 18, depending on a variety of factors, you're going to see this sort of project become more and more perilous. So this is sort of a per unit problem. That is to say, it works on a per megawatt problem or a per project problem, but it's combining with the other problem that everyone's familiar with in interconnection, which is the length of the queue, to create a huge financial backlog in addition to a project one. So effectively, as you have less and less space on the grid and more projects connecting to it without the requisite transmission build out, you have higher network upgrade costs and also more projects in the queue. The result is striking. We used some data from 2022 to estimate the number of, the size of the, what we'll call reimbursable, and I'll explain that term in a second, reimbursable network upgrades in the queue. And the number was around 55 billion. Again, this is relying on several assumptions we're making about costs in different regions. But if you do that same analysis in 2023, the answer was 75 billion. So this is reflecting not only just unit cost accelerating, but the size of the interconnection queue backlog also accelerating. So you just sort of have this conflagration of problems that are basically built around the same thing. There simply isn't enough space on the grid for the projects we want to build, and more transmission or more development of any kind is just required to support all of this. The good and bad news is that the authorities that be at FERC have started to move on this. These have looked like FERC Order 2023. This was the cluster study analysis, which all of you are familiar with. In terms of how this would impact network upgrades, you could really assume that instead of like all the network upgrades hitting one project, so imagine there's $100 million worth of network upgrades around one substation, and they hit the first project in the queue, they can now be just spread around a number of projects. But that doesn't change the fact that the units on a per megawatt basis, that the cost of network upgrades is going upward and is going to cause significant problems. The second FERC order that was interesting was FERC Order 1920, which came out last year and was talking about long-term regional transmission planning, which I think is in everyone's mind the best way to solve this. Simply put, if you think of network upgrades as largely a function of the amount of generation and load on the grid compared to the amount of space in transmission, if we simply build more transmission proactively, as they had in Texas to connect it to wind fields or other examples you can think of, this would reduce the total strain and thus the network upgrades. But the problem with this is, even if you got buy-in from all of the buyers you needed to across state PUCs, across the utilities themselves and the developers, this would take a decade to implement. Transmission is just a significant infrastructure project that requires so much to get done. And so setting aside what are going to be obscene, interscene fights across these regulatory bodies, across IOUs, and then across states, you have an enormous build out that needs to happen, and we have immediate financial pressures that need to be solved. So my colleagues and I at Tower Infrastructure Partners think that there is a pretty direct solution that comes out of how network upgrades are treated across the country, but explicitly in certain regions. So this is all born from a 2003 FERC ruling, which basically said that network upgrades, because they generally benefit the grid, cannot fall on a specific partner, because then they're doing all the cost is falling to one person and the benefit is flowing to everyone else. So the way the ISOs and the utilities have responded to this is in a myriad of different ways. But the basic fact is in some regions, network upgrades are reimbursable. Specifically, we focus on WEC, CERC, CAISO, and MISO, but I'm going to really focus on WEC, CERC, and CAISO here because their policies are a bit more straightforward. But effectively, what that means is you can get payback over a certain period of time from the utility for whatever cash you put up for a network upgrade. Moreover, you get this at a promising interest rate, specifically the Fed prime rate, which was 8.5% as of the end of Q2. That has obviously come down as rates have generally come down, but nonetheless, you're basically 300 basis points above whatever the interbank rate is, and that can be quite promising to a number of debt investors. Moreover, the value for this is guaranteed. So this is going to be cold comfort, and I promise it will get better in a second. But you are guaranteed to get the full value of the payback at maximum of 20 years. If you haven't been paid back in 20 years, you get all of the interest you've accrued and the original principal back in 20 years. But these timelines for payback are often far shorter, 5 to 7 years post COD. So what you have here is a value guaranteed, highly lucrative debt instrument coming from utilities themselves. And this represents a very financeable solution or a very financeable situation for specific types of investors to jump in and provide capital and then reap the returns of a lower risk profile and higher returns down the line. And again, I want to emphasize that like the policies guiding these returns are on a utility and ISO basis, but they can be as straightforward as CAISO, where it's a 5-year levelized policy, or in WEC and CERC, where you have to go to the individual utility and understand, and there can be pro rata generation agreements. But again, this is all very favorable for pretty basic innovation and from a financial perspective. And moreover, it is assured not in like interscene documents that you have to go crawling through, though often some of the policies for payback are, but the assurance of this policy is in the LGIAs themselves. Specifically, the FERC pro forma stays out that the advanced network upgrades must be entitled to cash repayment, and moreover, that must be paid back at a certain interest rate. Again, that interest rate can vary across utilities, but it is very explicitly in these LGIAs. And moreover, you can assign those repayment bases to another partner. So what we're looking at here is a very favorable, if long-term and so inconvenient, payment structure with firm legal basis in the basic documents that guide how generation projects move forward. So we at Tower Infrastructure Partners thought this was an extremely lucrative place and an extremely needed place for very simple financial innovations. We've created what we're calling a network upgrade asset, but your mileage may vary on that term. In the end, no matter what you call it, we have a pretty straightforward transaction. What happens is you, the developer, get a network upgrade cost from the utility and then interact with us and say, what percentage of this would you give me a percent lump sum for? So in this instance, the developer comes to us, says, we have this $100 million network upgrade, and we say we can do 85, 90 million. We're basically providing upfront capital for them at the time of interconnection. And then what happens is the reimbursement rights are assigned to us. So I think there's a lot of nuance in how that happens, but the basic relationships here should be clear. We are interacting with the developer before FNTP and dispensing cash post COD, and then are interacting with the utility after the fact. And I think this timeline right here should make this very clear. What's happening is the key events happen sequentially and therefore make the cash flows less risky and the sort of opportunities very clear. Prior to FNTP, but after the network upgrades have been assigned, you interact with us to say, we have this schedule of network upgrades and we need this amount of cash. We negotiate a way of saying, okay, we think given the risk of this project and the risk of several other factors, this amount of a discount is called for. We sign an agreement and then dispense cash to you between FNTP and COD for the amount that we owe you for the project. So this is a very simple financing arrangement. But the key detail is post COD, our interaction is then with the utility. What we're doing is working with the utility to get repayment that comes from the project itself and for the network upgrades. So it's a triangle where basically we serve as a hinge point between the utility and the developer. So what developers get from this is very straightforward. We've already mentioned the significant capital constraints that these higher cost network upgrades represent. And we simply relieve that from our partners. You have to put up less capital to begin with. You don't have to have it locked up for 8 years. And moreover, this can just improve your returns on a basic basis. Treating those in order, we're giving you 80 to 90% of the capital you need. That doesn't have to come off from equity. It doesn't have to come off of a balance sheet. Precious capital can be used for other projects, future development, whatever the case might be. But again, since this network upgrades are not ITC eligible, we can provide a very favorable level of financing that is attractive given the lack of the tax equity and a new capital stack is required. So basically, our offering not only doesn't require you to lock up capital, it gives you better returns than that. But I want to highlight what I think is the real appeal here. To date in this presentation, I've sort of treated the way in which the the way in which the repayment schedule is processed as pretty straightforward. And it can be, again, in certain regions, it can be very straightforward how they pay you back. However, in others, it is incredibly opaque. The utilities are sort of experiencing this spike in network upgrade costs themselves and are running around trying to piece together how to fix this. And as a result, the way in which they're paying back network upgrades is shifting. And you often have to not only be working in the area to know what it is, but have a specific idea about which person within the utility is responsible for understanding this, which is another way of saying that this is an area of risk. It's not just a simple cash flow. There are a lot of policies and mechanisms you have to understand, and those are opaque. So we provide not only the capital as sort of a benefit to this, but also a consulting function insofar as we understand what these policies look like and can explain them to you. And then not only that, but bank on them in quite a literal sense. And I think this really provides a lot of value, particularly as more and more of the project costs will get swallowed by needed network upgrades. I also think that what we're doing here should be understood as in some ways breaking out the network upgrades from the rest of the project. In some ways, this makes sense on every level. First, like this is a much larger cost now. It's no longer $100,000, it's tens of millions. As such, it's not quite the size, obviously, of the projects themselves, but it is a significant capital outlay that might be considered that differently. Second of all, as I explained, it has different factors that calculate its risk, so it should be treated differently. But even more so, like on a pretty basic level, these are no longer like lines or wires. These are upgrades to entire substations and transmission lines. And it's physically a different project. But it also comes with a completely different risk profile that we think is very favorable compared to the rest of the project. There's very little risk with the PPA and the offtake agreements. Again, our arrangement is with the utility itself. If the project is destroyed, like just imagine that a sinkhole, like you complete the project at COD and then it's on day one swallowed by a sinkhole. There are policies within the LGIA that say any project that then uses your network upgrades has to pay you back. That would be us, the people who own the repayment structures. And moreover, the cash flows for these things are OpEx to the utility. So this isn't even utility debt or which is among the safest debt in the world. It is actually just a cost line item. So we sit ahead of all of this. There are another variety of other things that make this more attractive and, a safer investment. I would highlight again that we are working with the utility as a cost center for them. So this is just an attractive sort of financing vehicle that is distinct from the rest of the project itself. And there's a lot of benefits from cutting it out. What I would also add is that what we're effectively talking about here is a need for transmission. And a need for transmission is a need for capital to build transmission, right? I'm not even going to read the top bullet point or touch on it. We all understand that the size of the transmission system effectively needs to grow by 50% in a very short period of time. But what that means is a lot of money needs to flow into transmission development. And right now, investors don't have a lot of attractive ways to do that. You can invest in the IOUs or the transmission owners themselves, but that obviously has complications as the IOUs have different sets of incentives when it comes to building transmission. You can invest in engineering firms or construction firms who are doing this work, or you can invest in like very valuable and very important like transmission developers themselves. And those are totally viable options. But what we're offering is an opportunity to invest in a specific transmission asset itself, right? This is no longer a vague investment in a certain portfolio or broad portfolio or a specific function of transmission. It is a specific transmission build out that is tied to a specific piece of generation. And I think that is quite attractive, particularly when you consider how diversification could add to your geographic or lower your risk from geographic and counterparty risks. So just to sort of tie this all together with what we're looking to do, what we want to do at Tower Infrastructure Partners is originate these NUAs, identify opportunities, be talking to developers, utilities, find out where there are these issues, where these finance sort of moments are happening, and then figure out this is a project that would work for us. Then our job is to build the full model, understand what the value of this network upgrade is, how financeable it is, understand how we could break it out, and then create the investment itself. And then fourth and finally, we want to be a platform. Like we're in the early going here, not looking to sort of finance these network upgrades ourselves, though that could be something more attractive in the future. Instead, what we want to do is be a platform that connects investors into the opportunity that is represented by the development that's occurring on the ground. And just to sort of circle around this, my colleagues and I are here early days, so we can't fully be, we're still in a bit of a stealth mode, so we can't fully come out. But between the four of us, we have 20 years working both within and with utilities, doing all sorts of development, both in transmission and in energy development, and have sort of worked around the financing aspect of this time and time again. So just to put a final bolt on this, we're really looking right now for projects. We're actually speaking with a few developers about projects they have in WEC and CERC, but we would love to find any projects you guys have with network upgrades that are crippling your sort of returns or that you need to understand better in WEC, CERC, or CAISO, which is where we'll start before we're expanding to the rest of the country. And really, we just want to understand the problems you're dealing with, where those problems are coming up. And, you guys can feel free to reach out to me at avery@towerinfrapartners.com, and we can just discuss the project you have and how we might be able to help you, finance this and get these projects moving forward. Because I think at the end of the day, what we really care about here is that, this is both a real cost, but it is also a significant opportunity to not only create a new way of investing, but to keep, the new renewable projects online and keep moving forward. Thank you, guys.
Great. Thank you, Avery. Well, both of you, this has been super fascinating. Obviously, I work in this world. My clients run up against these challenges, and the data you provided, Joe, and the insights you gave, Avery, were super helpful. A few questions I wanted to ask. Maybe I'll go to Joe first. Joe, can you talk a little bit about what the data shows regarding cost variation by project size? And I just guess I'll give you a hypothetical. For example, maybe utility scale projects that are 50 megawatts and less versus those that are maybe 80, 100 megawatts or more. And what does your data show about cost variation by project size?
Yeah, so in general, we the underlying data is again, unfortunately, very heterogeneous. And so, like, even though we find some broad directional trends, there are many location-specific elements that are independent of generator size alone. But overall, it seems that there are economies of scale, and that very large generators have lower integration costs than medium-sized generators, and so it doesn't scale proportionally to the size of the generator. Very small projects, so those under 20 megawatts that don't fall under the LGIA, they seem to be a little bit of a different beast. There are some that can interconnect really, really cheaply, and there are others that do have very, very high interconnection costs. So it kind of really depends on where you are, and what the local network situation is. One other small item in terms of reimbursability of upgrade costs under the ITC. In general, projects larger than 5 megawatts cannot receive ITC upgrades or benefits, bonuses, I guess. Many of the very large projects, of course, choose now PTC over the ITC anyway. But even if you were to choose the ITC, only if you are a very small project under 5 megawatts can you finance some of these interconnection costs. There's still a little bit of discussion how to do that with wind, and where like the project size is assessed in terms of qualifying facility, whether that is at the individual turbine level or at the full project level. But then again, like wind historically has chosen the PTC and not the ITC.
Awesome, great, thank you. Avery, so question for you. We were supporting a client selling energy from Mexico into the CAISO. They do their initial study. Network upgrades seem pretty manageable within the range of what they expected. Their particular cluster got frozen, got started again. Utility or CAISO, I guess in this case, comes back with the next study, and network upgrade costs now have ballooned to almost $750 million. Obviously, that killed the project. And now the way you presented information, it makes sense that you should break out the network upgrades, and it makes sense the way you presented it that these should be broken out. Can you tell me a little bit more about why do you think it hasn't been done before, that the network upgrade costs have been broken out from the rest of project financing?
Yeah, it's a great question. And that's obviously a very extreme example, but it's fit for the point, right? The reason that network upgrade financing hasn't been broken out is that traditionally it hasn't been that big of a cost center, right? Like you're not going to pay attention to something as a line item unless it really moves the needle. And $100,000 charges just weren't that interesting to developers who had far more salient concerns around securing land, about obviously finding off-takers, and then obviously sourcing materials as they needed to and labor. And so as those problems have I want to say those problems are solved. Developers are obviously working around those problems all the time. But as network upgrades have grown as a cost consideration, they now need special consideration, or will need special consideration, when you can't simply lump it into a traditional debt cycle. And if you're wrong about some particulars, it doesn't really impact you. If the size of the network upgrade is almost $1 billion, that requires you to better understand what are the exact mechanisms that the CAISO is going to use, not only to fund this, but then you're going to charge you and how it's going to look. Yeah. And so I think what you're experiencing there is an extreme version of what we're concerned about and what we're trying to solve, right? What we want to solve is say, okay, this is a significant expense, but it need not kill the project, because there are ways to finance this that not only will help you move forward and not put down $1 billion, as the case may be, but also will help other investors get into investing in transmission and moving forward.
Great, thank you. Joe, for those RTO ISO areas where network service are applicable, so ERIS, NRIS, what does the data show about cost variation by network services?
Yeah, so it used to be the case that ERIS network services, one could get cheaper and for quicker, and that NRIS came with bigger network upgrade needs. So maybe stepping back one step, both ERIS and NRIS, energy or network resource status, allows you to participate in the energy market, but only NRIS really has deliverability and enabling you to participate in capacity markets. Now, depending what kind of resource you have, if you have storage, you probably do want to have the full capacity credit in order to participate in capacity markets. If you're solar standalone and you're in regions with increasing solar penetration, the capacity value may go down and you may be more willing to forgo that. So overall, there's a big discussion in whether or not we can differentiate interconnection services a little bit more and allow some developers to take potentially a higher risk when it comes to congestion and potentially lower local marginal prices, energy prices, but foregoing some needs to have higher network upgrade costs. Now, maybe in a future where TPI is very successful, that is not called for anymore. But at least in the interim, it seems that there are additional reform opportunities to further differentiate ERIS and NRES and really identify where can one move ahead with ERIS that allows new clean energy capacity to join the grid without being bogged down in long network upgrade proceedings and then associated costs.
Great, thank you for that. Avery, is there a specific type of investor you're looking to buy these network upgrades? I mean, what type of investor should be looking at that?
So it's another interesting question, and I imagine that like the the broad answer is we will connect anyone who's interested in this to the pipeline that we're building and the platform that we're building. But I think this is particularly interesting to people who want safe returns in a green asset. The way I would explain this is the last time I checked, like IOU bonds were around 5.5%, right? And they could be as high as 6%, but you could buy utility bonds at a 5.5% yield. If you think of this, the interest itself is 7.5%, 8.5%. And once you do certain, again, de-risking and combinations, you can increase that return pretty significantly. And so what I would say is like, this is a very, I don't want to say anything is safe. Like there are obviously risks in all investments. This is a new category. I don't want to promote this as overly safe. But frankly, what you're paying, what the developers are paying for is not to have capital tied up and to be able to invest elsewhere. And so more patient investors who are looking to sort of interact with a green asset that has a safer counterparty, this is an extremely attractive investment. We've had productive calls with some family offices. We've also spoken to larger infrastructure investors who are looking to diversify their green asset portfolio. Mm-hmm. So those are two minds that immediately come up front. But I think this is an investment that could be attractive to a number of financial vehicles.
Awesome, thank you. Well, we're winding down. Joe, any summary, any last minute commentary that you'd like to add?
No, I think we just maybe highlighting that this is a space that is evolving. Many people have now finally understood that this is a bottleneck for new clean energy development. Many smart heads are being put together trying to solve that. But the process is can't just be top down. There's not one single solution, but it will be devised by stakeholders and many working groups within the individual ISOs. So that remains an area where I think we're going to see a lot of evolution over time. One of which being financial innovation, such as TPI, and I think that is what makes this exciting. The stakes I think are high overall, but there's some reason for optimism that things can change.
Great, thank you, Avery.
No, first of all, thank you for having me, Ruben. I really appreciated this opportunity. What I would just jump on is, Joe is right. This is going to require some financial innovation and policy innovation and the rest of it, but it also relies on like steady research and really impressive and like I call it detailed scholarship, which I think LBL and a few other public entities are doing a great job of. And I would really encourage all of you to dive into what they're producing, because there's a lot of interesting stuff that will come out there that can help inform the future of energy. So, thank you so much for that. And thank you again for having me.
Thank you. So just in closing, again, thank you to both of you, Joe and Avery. Really fascinating subject matter. I think from my perspective, I think the days of, interconnection, network upgrades are something we're going to have to deal with as a developer. And if, we just put our heads down, we'll eventually get through it and our project will be successful. I think those days, for the most part, are kind of gone. We really have to look at information, like you said, very detailed information data. I think there's a lot of us in the development world that are looking at Berkeley National Labs, NREL. There's a lot of information that we're looking at to be really open-eyed about how you approach those projects and identifying the risks. I think one of the slides you presented, Joe, it's pretty telling. You know, I understand some of these projects are speculative, so people are just testing where they should best interconnect. But the numbers to see, 78 to 80% failure rate for solar and maybe a little bit less for wind, that's significant, right? So I think if you're just thinking, we'll just brute force our way through this, I think you could be in for a really rude awakening as a developer. So I think these solutions, and then also obviously, I think one of the common complaints of developers across the nation is we're essentially giving really low cost loans to an IOU or ISO to build out transmission systems. We're kind of being the ones where transmission systems are being built on. And I think, Tower Infrastructure Partners solution could be a really good opportunity for some developers to really move their projects forward and get past the risk that these network upgrades impose to them. So again, everyone, thank you for your time. Appreciate it. And feel free to reach out to me. And if you have my email, you can message me. I'll put you in touch with Joe or Avery. We will get out these the presentations soon, and we will post this recording again for replay for those of you that want to watch it or share it with anybody else. And thank you, everybody. Have a great week.
Yeah, thank you so much for your time and
Bye.
attention.
Thank you.